Why do startups fail? Well, in this video, we're going to take a look at a couple of critical financial issues. Previously, we've looked at 4 potentially fatal management-related shortcomings, and now we're going to look at the final category, financial, and 2 critical issues. The first of these sounds pretty obvious, running out of cash, and the second one is pivot gone bad. So, the company ran out of cash. Well, yeah, this happens more often than you would believe. The question really is, how should the company spend its money? The thing is, you've just raised a round. You've got a certain amount of runway, which is basically how many months of burn rate have you got until you run out of cash. And you therefore need to anticipate the next funding round, and you need to have some clear milestones in place. It's not good enough to simply think we've got a whole load of money in the bank and now we can basically spend it on anything we like. Poor financial controls and management can be fatal. And a company running out of cash is normally because they didn't manage their existing resources carefully enough, and they didn't address the next funding round soon enough. And you basically start your next funding round effectively as soon as you close the current one. Don't forget, it takes at least 6 months, or you should allow at least 6 months to raise a round. Now, all the time in a startup, you need to be very aware of the cash flow, the break even, and the runway in front of the business. I would go as far as to say that the CFO should know exactly to the dollar how much money he has in the bank, in cash, every night at close of play. It needs to be that tightly run. And it's the responsibility of the founding team and the management, particularly the CEO and the CFO, to take active steps to ensure that the funding raise is done in a timely manner. Now, one way to look at this is to have clear milestones. And at each milestone, you're de-risking the business and you're also potentially increasing the valuation. And some milestone examples are listed here, and I'm going to go through them. First of all, you can reduce risks by hiring, completing your team hire, overcoming some technological obstacles which may be facing you in the development of the product, producing a prototype, getting your first customers. You can then have a successful beta test and get customer validation. You can actually ship your first product, get early paid customers and positive feedback. All these things confirm and encourage investors to be confident in the business. You can get your product market fit right with an updated feature set to improve gaps in the initial release. You can prove your business model with customers and commence scaling, making sure that you have a low cost of acquisition for your customers. And having demonstrated successful scaling, you can then raise more funds at a higher valuation to accelerate growth or expansion. Go for a land grab as the first mover, or ensure you have sufficient working capital to enable growth. Now, the failure to meet milestones at any point, of course, has a negative impact and can lead to a reduction in valuation or a failure to raise cash at all. Remember, cash is king for startups, and if you're desperate and you're running out of money, investors will sense it and will eat your lunch. They'll either walk away or they'll give you such a derisory valuation that you'll get completely scalped. So you need to ensure that you take steps to make sure your funding raise is done in a very timely and well-organized manner. The other issue is when the pivot goes bad, and this basically is another case of running out of money. The first iteration hasn't worked. It's a large-stitch attempt to save a business before it runs out of money, and while the technology and the vision might be great, if there's no compelling need or opportunity to scale, it's likely to fail. Now, as an angel or a VC, you need to keep your radar alert and working to ensure that your company is contemplating is working well. And if it's not and it's contemplating a pivot, then you need to make sure that you get involved and that the decision to pivot is made on a timely basis. It's the right decision, it's the right type of pivot, and it's going to result in a successful saving of the company, because any pivot is critical to a business, and if you get it wrong, ultimately you'll probably just collapse. But the likelihood is that in trying to pivot, before you can be successful, the company will run out of cash and you will have to fold it. So that is a series of 21 issues which I think are critical. Can you think of any more? If you can, definitely let me know. In the final video, I'm going to summarize and wrap up this series where we've been asking the question, why do startups fail? And in this video, we've looked at financial issues. And I hope that you can understand that cash management and financial management is at the absolute core of any startup. And if those aspects of your business are weak, then you are very likely to fail.